Hey there, welcome to CNT Collectibles. I am C. Hope you're doing well today, and I would like to talk about correlations for a few minutes here. So, hear a few things from time to time about correlations. Are cards correlated to anything? And thought I'd dig into that a little bit. I'm interested because sometimes there are some unusual things that do happen. We've got a lot of people in the finance industry that will look at lunar cycles and sunspot activity to try and come up with correlations. People try everything, so we're going to throw some things against the wall and see if they stick. But one of the big reasons you look for correlations is you want to find things that are not correlated. So when you're diversifying, you don't want things that are moving together. You want things that are moving oppositely. So you can see here that what works well in one year may not work well in the next. And so if you spread things around a little bit, you wind up shooting down the middle, because it's pretty unusual that people can make all sorts of predictions, but it's a little bit unusual for someone to nail the next year how things are going to come out in a specific order in terms of total performance. So again, just thought we'd take a look at a few things here and explain what correlation is, why it's important. And there's times that things work, that things are correlated, and there's times that things aren't correlated. So two things that should be really, really correlated, sometimes aren't. And so these are stocks and bonds. Here's the S&P 500. Here's the yield on the 10-year bond, and you can see it's been trending lower since 1981, from a high print of like 16% down to a little over 1% now, almost negative for a period last year. And these should be moving oppositely. As yields decline, your bonds should increase in value. If you've got a bond at 5% and they start issuing new bonds at 3%, more people are going to want this one and they'll pay more, and your price goes up. So as those yields go down, the bond prices go up. But you should see money coming out of stocks to do that, and stocks should go down. But you know what? They've done just fine. There's times that correlations work, and there's times that they don't work. And so you can measure this with a correlation coefficient. And so as things are perfectly correlated, they will move with each other. And if they're negatively correlated, they will move opposite of each other. So you can see here, as yields went down, you had a lot of negative correlation. Stocks did just fine. Then you had some high correlation in the tech bubble and the housing crisis in the 2000s and 2008 area. Here you had a lot of positive correlation. So as those yields went down, so did stocks. They kind of moved with each other. Now you've got that divergence again. So sometimes you have not anything that obvious, but you'll have just data points where you can correlate things. And so this is the yield curve right here, is the S&P. And there are times when there's demand for shorter term security, and this is called the yield curve inversion, and yields on those short term things go higher than the long term bonds. And so when these things invert, it is usually a warning sign of a recession, but not always. But here, 2000, yield curve inversion, tech wreck. You had yield curve inversion, housing crisis. Yield curve inversion in 2019, whatever that was, and a big puke here. So correlations can matter, and it's important to pay attention to them. And so if we can find something in the sports card market, I think that would be perhaps beneficial. So Juan Soto, Fernando Tatis, Ronald Acuna Jr., some of the young guns here, moving pretty similarly. So we've got a little divergence lately. Mr. Acuna is out for a year, so obviously he's going to lose a bit of interest in his cards. But for the most part, there's been a lot of similar moves. And so my contention has been that cards are more of an asset class. More specifically, their own asset class. So to find them correlated with other things, I think it will happen from time to time, but it's probably not going to be a perfect correlation. So here's some of the older guys: Pujols, Griffey Jr., and Mike Trout. Not that old, but legends of the game, let's go with. And so you can see that they've tracked similarly as well. And so when you take some of those other players, those younger players, you can see that they don't move quite in similar fashion. So you can break it down within the card industry as to some of the younger players that have a potential track, and some of the more established players that their track is a little bit more well known. So you can see it here: Jordan, Luka, LeBron James. And Jordan and LeBron have moved similarly. You had a similar peak and a decline, and then right now there's a little bit of a divergence here as LeBron's getting a Gary V bump. Jordan is not, but I think he's starting to get a little notice on his own with record PSA 10 sales there, kind of that one-off here. But Luka peaked well before these guys and went down, so again, a little divergence. And so if you want to diversify within the card industry, then some of the younger players, some of the older players, and you can have a happy mix down the middle. Football, Mahomes, Tom Brady, kind of the same thing, tracking relatively similar. So the price values are different, but the moves are kind of the same. So I think there's a lot of correlation in the card industry as long as you pick the right cards. But when it comes to the card industry versus anything else, I guess that remains to be seen. So we'll work with Trout, Tom Brady, LeBron James, and so it starts from the top down. LeBron, Brady, and Mike Trout, and we'll just compare them to a couple of things here and see what we see. So as this goes back a couple of years here, so this is the top in 2020 before the big puke. Some people say it's COVID. It's like, no, those were hedge funds blowing up. People don't drop Coca-Cola down 18% in a couple of days unless they're forced to sell. So something else is going on there. But so as this peaked, the card market actually started to rocket up. So there was relative safety in the card market here. But the last couple of weeks of the decline, everything was liquidated, and cards weren't spared from that. But everything kind of made a bottom at the same time. Cards did that from a higher point, and obviously stocks from a very low point, so they didn't have to go back and test their previous lows or anything like that. And then you had this consolidation September, November. Cards consolidated, went down just a little bit, underperformed, and then everything kind of went up again here. And so then you had your February peak, but there is a divergence as the S&P Broad Market Index is continuing to make new highs. Right, they're hanging in there, all right around there. Cards down, 50, 60% in some cases, even more, and some even less. But for the most part, there is a divergence. So the correlation isn't quite there. But your card collectors, you guys are aggressive. You're on Star Stock, and you're buying crazy high-level refractors. So your risk appetite is a little bit higher than people buying Apple and getting a dividend or something like that. So let's look at the Qs then. These are the NASDAQ names that are a little bit more high-flying. You've got a lot of biotech in there as well. So your aggressive investment, maybe you're more correlated with this here. So here's your peak. Card market again. So they peaked along with the S&P. So really with the equity markets, a lot of these things do move together to a certain extent. 70% of the time, that the return of a stock or not a return of the stock, either way, can be explained by the direction of the market. So there's times where things underperform, but for the most part, they kind of move similarly here. So, all right, the Q's peak and cards went up, bottomed, kind of at the similar time here, and went on a nice run. And then you had this consolidation again, August to November consolidation, where cards underperformed a little bit, but then you had a nice run up again. And the peak in February for cards, stocks kind of, but they have recovered. Cards have not. I think they're going to try and do that. So, anyways, the Qs. Yep, not aggressive enough for you. Small caps, these are pretty aggressive. These are smaller companies, and they're not that small. They're like $2 billion, $5 billion companies, but they've got the largest potential for growth. Maybe that's you guys here. So, all right, maybe that's us. I'm a collector as well here. So, all right, peaked a little bit earlier than the rest of the market here. But cards kind of went on a run, and they did go on a run. So just like they did against the other indices, they did just fine. So, but the bottoms kind of came at the same time after a small correction for cards, big correction for stocks. Then you had your consolidation in this area. Small caps they lagged on the way back up here, so they didn't really quite get it going here. Cards outperformed. A lot of sideways action. By the time small caps put in a new high, cards, they were well above their previous highs here. So, well, not these highs, but these highs back here. And then you saw a nice rally out of everything into the end of the year. And then a lot of consolidation from small caps, and a lot of consolidation, if you want to call it 50, 60, 70% of consolidation, forget it. Crash for cards. Small caps, they've held in. They've underperformed, but they've held in all right. So this isn't quite right for you guys either here. So not finding a lot of tight correlations. From time to time it works, but not looking like there's anything out there that really does it as of yet. Commodities, beginning of January. So maybe there's an inverse correlation here. Cards ripped while commodities got spanked. You had a bottom in a little bit later than the rest of the markets here. So as the rest of the markets bottom right in here, commodities continue to drip lower. Cards didn't. So monster rally, and then a lot of consolidation. Kick off a new leg here, and by the time that commodities started to make a new high, really in February of this year, cards had started drifting lower. So maybe there's an inverse correlation. So maybe if you start looking at the commodity index, flip it upside down, you're going to find the correlation that you're looking for here. All right, Bitcoin, this is you guys for sure. All right, minor top way back in 2019, actually pretty significant top. This was like the first time it hit 20,000, went back down to like 5,000 here. Cards went sideways, so they held up a little bit better. As Bitcoin drifted low, then you had the low in March, and the cards again, they did just fine. So they corrected a bit, but they're well above their previous highs here. So then you had your rally, and then we'll look at the breakout in Bitcoin where it really sent things flying, and then cards went flying as well. In February, you had kind of a peak in Bitcoin. You know, it started its topping process here and got cut in half. Cards topping process cut in half. I think we might be onto something here. So maybe Bitcoin, if you really need to not look at cards, honestly, just look at cards directly. If you need to look at something else just for confirmation, maybe that's the way to go. But I'm thinking there's one more thing here. So the Nationals coming up. I've been to conventions before. I know how they go. I've been to a sports card one, but I don't think you guys are wildly different than other conventions here. So you work hard during the day, and at night you need to relax just a little bit, take an edge off here. So we've got the Alternative Harvest Mary Jane Index here. So I don't know what you guys are up to. Let's just see if there's something here. So February you had a lift off, inversely correlated. The market peaked here, and then it was, again, kind of an inverse correlation, but now we're starting to see, you kind of have this bottom September, October. Card market, not quite a bottom, but you had major liftoff in a breakout. You're seeing liftoff in a breakout, and now peak in February, monster decline about 50%, decline of about 50%. What are you guys up to here? So maybe I'm missing something with the show. Not my thing. I might have to consider this event next year. You guys are splitting your money between a couple of things here, and I don't know what's going on, but I question y'all now. So, all right, have a good one. That's what I got for you. Be back at you in a couple of days. Take care.